What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is May 26th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to dive into the cryptocurrency derivatives markets. I want to dive into a new set of data that we don't always talk about here on the channel, and also take a look at equity markets to see whether or not we can gauge whether or not crypto and stocks are at overbought levels, they're at overhyped prices, or have we really come back down to center? Have we come back down to reality, and are crypto and stock prices at a valuable range to go long? I want to go ahead and dive into this as we go through the conversation. I hope you guys will stay tuned. It's going to be an interesting one right after our quick sponsor. And our sponsor for today's episode is Size. Centralized exchanges have historically handled large order flows, but with Size, these flows are coming to DeFi. Size is the DEX built for large trades. It allows pro traders to swap tokens with zero price impact through time-weighted average pricing, or TWAP. Not a whale? It's okay. Size benefits everyone by allowing accessibility, security, and fairness to on-chain trading, an important part of a mature and stable DeFi market. And with Size being developed by a team at Integral, a global team of mathematicians, financial engineers, blockchain developers, growth leaders, and early crypto investors, it's at the forefront of DeFi. Check out the link down below in the description to get access to Size today and start trading smarter in the DeFi world. Alrighty, everyone, so let's go ahead and kick things off here, diving in to the Bitcoin chart. As you all know here, we've been through two heavy corrections here since back here in November. The 52.2% correction back here from November to January of 2022, and then outside of that as well from late March here towards early May. And since then, we've really just been consolidating around this $30,000 range, waiting to really pick up a trend. So what I'm going to try to do today is get an understanding here as to whether or not we have the ability to even collapse down to lower levels. I think that's the fear that people have right now. Now, what's going to happen here in the short term, whether we come down here maybe to 27K or we come up here to 34K, no one knows exactly how that's going to play out. We have to wait and see what kind of move is going to happen here in the next few days. But what I do want to try to answer again is that fearful question that a lot of people have. Is it likely that we would come back down to 25,000 and worst off go even lower, especially for those who are already exposed to crypto markets? Well, I'm going to go ahead and explain why that's not likely going to be the case here and why we have seen our capitulation. Now, you guys probably already remember when we were talking about the Bitcoin all-time history index and we were taking a look at the weekly volume. That's the important thing here that I want to point out, that we tend to see these big spikes of volume when it comes to the bottom capitulation. And all the while we might chop sideways afterwards. Generally speaking, after these kind of capitulation candles in price, and therefore also in volume, we tend to see a decline thereafter in volume and price start to recover higher. You can see it back here even during the bottom of the bear market or during the capitulative sell-off at the beginning of the bear market back in 2017. And again, this is why we have to look beyond labels. It's just a matter of whether or not we're seeing the signs that it's time to either hold, buy, or sell in the market. Right now, I'm getting a holding vibe. It is not the time to panic here after Bitcoin's already gone down from $69,000 down here to $25,000. I want to make that very clear, and I'll put my money where my mouth is in the sense of my actions. Now, I want to go ahead and take a look here at the derivatives data that we have. If we take a look at what's known as liquidation data that's available on coinglass.com, you guys can get access to this for yourself. It's a really interesting thing to keep track of. And it will generally show you here how people who are either long or short in the market are getting knocked out of their positions. Effectively, when you get liquidated, you are losing your entire base amount of capital you're using for margin trading. So again, just to kind of explain this, just take a quick step back. For those of you who have probably watched the channel a lot in the past, you've probably heard me talk about how people are leverage trading, that there's a lot of credit driving the market, that people are trading on margin. And this effectively means that through some type of exchange, rather than just simply spot buying Bitcoin, right, going on maybe Coinbase or Binance or Kraken, and just buying or selling Bitcoin or your favorite altcoin with money that you already have, some people want to increase their risk profile and therefore their reward profile. So what they'll do is they will borrow, they'll pay usually to borrow Bitcoin to either long or short effectively. And if you have, for example, $10,000, you're able to bolster your position up to $30,000, $50,000, and therefore, with the market moves, be able to hopefully make more money. But it is important to note that you also are increasing your risk profile. If you, for example, are trading on 5x leverage, and the market goes up 1%, hey, you've made 5% if you were to lock it in and sell. But at the same time, if the market goes down 1%, you could lose 5%. And worse off, if it goes down low enough in price and you're leveraged long to a high degree, let's say, for example, you were 20x leverage. This is a bit of a dramatic example, but let's just say for safety's sake, you were leveraged 20x. That means you're trading with 20 times the original position. If the market goes down 5%, you're likely going to lose everything. You're going to lose your entire base position. And sometimes platforms have even tighter liquidation settings that'll effectively get you liquidated on an even lighter price decline. Right? So it's important to understand just how imperative derivatives markets are on the crypto space, because people have really been levered to the teeth over the past few years. Derivatives markets have played a larger and larger role on top of the existing spot markets. Effectively, almost the spot market has become a tool to liquidate and knock people out of their positions in derivatives markets, because people have just been taking way too much risk on in the market without any type of risk management. And you can see that here as we've had hundreds of millions of dollars liquidated on both sides of the trade. Through the longs here, which are highlighted in the green, we can see these are the aggregate numbers with all the exchanges mixed in, but at the same time as well, the shorts getting liquidated. Now, I want to go ahead and talk about some interesting telltale signs here that we might have the worst beyond us here. First off, when we're going through capitulation here, you'll notice that the candles that are spiking up here, when the yellow price here, which is Bitcoin, is starting to trend downwards, we see the longs getting liquidated. We see more of those green candles. And that's technically, I guess, in the sense of where most people are when they're long, this is not a good thing, because it's effectively meaning that people are getting knocked out of their entire positions. And that's generally going to cause a cascading sell pressure on price. And that's why, again, as we enter in towards the capitulation lows of the sell-off here, right, when we really saw the majority of the decline here, it's no coincidence that we're seeing a heightened amount of longs getting liquidated, especially much more than the shorts. And over time here, once price starts to neutralize out, notice how the long liquidations start to generally decline. We have some anomalies here, but generally it's going down, never revisiting back to the previous relative high back on May 8th. Now, the important thing that I want to point out here that we can start to use this liquidation data for is that as we're starting to enter in towards a neutral trend, we're waiting for the market to showcase us the next move. We're waiting to see what's going to happen here, because we know that if a lot of longs get liquidated, right, that can cause a cascading sell side pressure on price. But the opposite can also happen as well. If enough shorts start to get caught up in the red, basically the price starts going up enough, they can get caught up in what's known as a short squeeze. They can effectively be forced to buy back original positions and therefore drive prices higher. Just like how longs getting liquidated can cause a cascade of sell pressure. And this is why, again, we've been seeing more dramatic rallies and corrections over the past year and a half to 2 years in crypto markets. Plain and simple, there's no room to argue it. It is the key reason why we have started to see distortions in crypto markets. Now, all the while here, we have started to see some more kind of highlighted days here of short liquidations, definitely a heightened amount the other day. I don't think we've got enough data yet, but it's at least something we can watch here, where if we start to see more and more days where the shorts, in the sense of liquidations, are outpacing the longs, so the red candles there's more big red candles rather than big green candles, that is going to be your telltale sign that a short squeeze is coming and that price is probably going to accelerate higher, and vice versa. If we start to see a build-up trend like we saw here, for example, in longs, this was kind of an early telltale sign here that we had this kind of these days of expansion when longs were getting liquidated here, right? That could be a really good telltale sign that price is about to collapse and cause an even higher cascade or domino effect of liquidations. Now, one thing that I think is really important to look at is equity markets, because this is not just the case in crypto markets, whether you're talking about price action or leverage. We can see here that the S&P 500 has had consecutive negative weeks, up to around 7 consecutive negative weeks. We've rarely gotten this. I think the last time we saw this was back in 2000, the collapse of the dot-com bubble. We saw, again, a similar level here back in the 1970s or early 1980s, and here as well in the early 1970s. So this is really a rare period of time in equity markets, this consecutive sell-side pressure. And we can see this as well in other metrics, right? The price to earnings ratio, the 90-day change in the forward PE ratio, coming back down to levels we saw back in March 2020 during the collapse of Lehman Brothers back in 2008. And investor sentiment, as it is in crypto, is an extreme fear, right? These are all the conditions here that showcase something has been going on. Not only have equities just been in decline, but we have been in a deleveraging, okay? And when you deleverage, this is a very fancy term, meaning that people are lowering their margin levels. They're not borrowing as much to buy positions in equities and hopefully make a profit. It's a sign of coming back to reality, getting away from the kind of the roaring 1920s punch bowl days where easy money's everywhere, everyone's rich, everyone's a genius when the market's going up. Because when the market comes back to center and there's enough selling on the spot market, those who are trading on derivatives or on leverage are going to get caught red-handed. They get liquidated. They get forced out of their positions. And now we've seen year over year a net negative decline, about $75 billion in margin debt, margin positions. It's very different from back here in early 2021 when there was a net change year over year of $350 billion. One of the biggest spikes we've seen in history year over year. There was a lot of easy money. Now that's started to change here. But I don't want you guys to get fearful from this news. I'm not here to showcase here that, again, we should run for the hills. What I do want to showcase here is that according to history here, in the sense of the year-over-year change, or even percentage change, we're starting to get into territory that's generally more favoring of the bulls here. Now, it looks like we've still got a little ways to go, a little bit more cool down, a little bit less risk-taking than what we saw back in the past. People kind of leveling out their financials. But we're at least not in the kind of hyperbolic, high-end trend here that we saw back in 2021, or here in 2007, or here in the 1990s, right? We're coming back down to center here. And whether it's going to be a couple of weeks, a couple of months, even here as we're starting to decline here, doesn't mean the price can't be expanding, right? So we've started to enter, and I think, the late phases of the sell-off here. It's a big reason why all the while we've been talking a lot about Bitcoin coming down to this range, and even, yes, maybe coming down to 27,000, getting a little bit volatile here, chopping around in the short term, that we've probably seen the capitulative lows here for crypto markets. At least here in the short term, where we should expect some kind of relief rally or rebound in price, just like we did back here in January of 2022. We can see it here within the data here. And we have to, what we want to look for here, and I would say, again, it's not something that's absolutely final. I don't want to talk in absolutes, but one of the things you can do is watch these kind of market metrics, watch what's happening in the derivatives markets. I think just like how we like to do price analysis here, we like to look at data science, I think it's another great tool in your toolbox that you can use to analyze the market and see where things are heading. And we're going to continue to keep an eye on this to see where the markets go over the next few weeks. If we start to see more and more of those red candles, that could be a telltale sign that things are about to turn south. No, excuse me, more of the red candles would be turning north, in this case, price going up. And vice versa as well. If we see a lot more of those green candles getting liquidated, people still not learning from their mistakes in the past, over leveraging themselves, it can be a telltale sign that we may be on the wrong end of the stick. The price is going to go lower back to potentially 27K, 25K, or lower levels. I don't want to speak in absolutes here because we gotta wait for a trend confirmation. Anyways, that's it for today's video, guys. I hope this provided some value to all. Another tool you guys can use. If you like the video, consider dropping a like, consider subscribing and hitting the bell icon, and feel free to check out Integral down below, the link down below in the description. But until the next video, everyone, thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.